The overwhelming question we're getting today from investors is low yields, and then how do I fund retirement income? And one of the mistakes, I'll start with that, is investors potentially leaning towards high yielding securities, whether they be high dividend equities or high yield corporate bonds, or going up the risk spectrum of fixed income. We really believe in a total return approach. A total return approach is being not re-engineering the yield, but making sure that you have diversification in stocks and bonds and spend out of your total return of the portfolio rather than concentrating your assets on high yielding securities. There's been so much worry and concern over rising interest rates, and surely I think what we've been very clear to communicate is what low interest rates mean is lower future returns. What low interest rates also mean is a higher probability of negative returns. The question is, what would you invest in if you leave fixed income? Money markets, the yield curve is quite steep, so the pickup from an intermediate or short bond to a money market is quite severe. And then the other thing is, would you go to equities, which are much higher risk? So while there is certainly lower return expectations on bonds and a higher potential for risk, we need to put those risks in perspective. We've just seen an incredible 6-week rise in interest rates from May 1st through the middle of June, and the returns on bonds have been slightly negative, certainly nowhere near a bear market on equity returns.